welcome to a brand new episode of Smart Money. Now, this week was by far the most hectic week in the primary markets. Nika saw a big bang listing, hitting that 1 lakh crore market cap value on listing day. India's biggest IPO so far, Paytm, also opened for subscription this week. The issue saw muted subscription, but in 2021 so far, lots has happened. 46 companies floated their IPO to raise a total of over 80,000 crores. Experts believe that this year should close with 1 lakh crore of primary market fundraising. In fact, this week itself, 3 IPOs, Paytm, Sapphire Foods and Latent View Analytics opened. So on Smart Money today, we will tell you which IPOs to buy, which ones to avoid and which ones to sell post-listing. Alright, but first up, as I said, the initial public offerings have generated a lot of buzz in 2021. My colleague Yash Jain is here with all the key highlights. Yash, over to you.
Year 2021 is turning out to be a blockbuster year for the primary markets. From new age IPOs to phenomenal returns, it truly has been an explosive year. Here's a quick look at the IPO action in 2021. Over 1 lakh crore has been raised via IPOs this year so far, which has been a massive threefold increase over 2020. Next is where the money went. While in 2020, only 12% of the IPO funds went to the companies and the rest went to the selling shareholders, in 2021, nearly 40% of the funds went to the companies who are expected to use the money towards expansion, growth as well as retirement of debt. Let's run through the list of the biggest IPOs. Paytm tops the chart here with its 18,300 crore IPO. That is followed by Zomato with its 9,375 crore IPO. And finally, we have PB Fintech with its 5,708 crore IPO. Speaking about investor interest in these IPOs, Paras Defense IPO was subscribed 214 times. That was followed by MTA Tech, which was 138 times. And finally, Tattva Chintan Pharma with 124 times subscription. Overall, in 2021, 28 IPOs were subscribed over 10 times, 5 IPOs were subscribed over 3 times, and about 9 IPOs were subscribed between 1 and 3 times. What about the day one listing gains? Paras Defense tops the list here again with a listing gain of 185% on the first day, followed by Tattva Chintan Pharma with 113% gains, and then finally Indigo Paints also doubled the money for its investors on day one. Beyond the listing day gains, which are the IPOs which are still the best performing from the issue price? Paras Defense so far has given returns of about 360%. That is followed by Nureka with 356% returns, and finally Barbecue Nation with about 250% returns so far. So it has been a blockbuster year so far, but as they say, picture abhi baki hai mere dost. That's because another 68 companies are lined up to raise over 1 lakh crore already. Besides this one, the big one would be the mega LIC IPO, which aims to raise about 70,000 crore rupees for the government.
Okay, that's a nice one, Yash. Picture abhi baki hai, so lots more coming up despite the huge fundraising we've seen. Well, our experts today, Bharat Lahoti, the co-head and fund manager at Edelwiess AMC, and Nika, founder at Capital Mind, join in to tell us what you should buy, what you should avoid, and how you should look at this huge boom in the primary market. Bharat, Deepak, thank you for joining us. Bharat, I want to start with you. You know, the IPO market is booming, as you just heard, both in terms of returns given by newly listed stocks and the number of issuances. But how does one look at it and how does one decide where to put their money?
Thank you, Shenoy. It's very normal to have large primary issuance in a bull market. We have seen similar trend in 2017 when we had seen around 36 IPOs coming out with an average listing gains of around 20%. This year too also, if you look at it, so far we have seen around 44 IPOs with the average listing gains of around close to 17%. Apart from easy money which is available, there is also buoyancy in market which has actually led to this IPO market. Apart from this, there is a structural reason which we think it's leading for IPO companies to come in. Over the last few years, what has happened is because of reforms, financialization of saving, formalization of economy, rising per capita income, changing preferences in the way we buy goods and services has led to many private equity venture capital firms investing in many emerging ideas. These private equity venture capital firms, in our opinion, when they mature, they tend to actually sell their some of the best investing company, and these companies are now coming for IPO. As just pointed out, private capex is also coming up. If you look at it this year, a lot of money has raised by primary money has been raised from that perspective. So private capex is also picking up. Promoters are actually getting up to raise capital from the perspective that economic growth is going to happen, and consequently that is leading to the IPO growth.
Okay, got that. Deepak, welcome to the show. We have to talk about Nika, right? That was the biggest listing this week, and it's been on a tear since listing day. Even on Friday, it ended up almost about 7% odd. For people who perhaps missed the bus, did not get the allotment, what do you do now? Is it worth buying or is it too late?
Hi Sonia, thanks for having me on the show. The Nika IPO is actually pretty huge from a lot of perspectives. It's crossed 1 lakh crore with a 60 crore of profit. Also the landscape of this business is quite huge. It's a vertical e-commerce company in a vertical space. There is potentially a lot more adjacencies that they can go after. They're not just cosmetics now. They have their own brands. They have clothing. They have a large number of very high margin products in a fairly fragmented industry where people, and especially the customers of this segment, are very particular about quality, about reliability, about in certain cases also anonymity, in the sense they don't want everybody to know that they're buying these things as well in smaller towns. So I think the business is a very good one. The price you're paying is extremely high. It's probably at an extreme, regardless of what kind of valuation metric you put it, to put 1 lakh or 1,20,000 crore price tag on a company, even though it may be fantastic company, I still feel that we're paying a little higher in terms of price for it. So what I would do is I would want to build a position in it over a period of time, probably a year and a half, and add as and when they show fundamental increases. I expect the profit is likely to at least double from here in the near future, simply because they've raised 600 crores. If they even make 10% ROCE on that, that is another 60 crores of profit. So apart from the 60 crores they already have. So I do expect that growth will come in. But I do think the price will also probably correct, and they will be volatile over time. So it's better to spread an investment rather than get all in right now.
Okay, spread out your investment rather than get all in. Bharat, I want to come to you on this. Typically retail investors do not get allotment in many of these IPOs, and most of the lucky ones participate in it only for listing gains. So what do you do at a time like this? How can retail investors participate wisely and build their wealth in these IPOs?
We think there are three sets of problems what a retail investor face while investing in IPO. First is the access is very difficult. If you look at the subscription numbers, retail investor don't get allotment. Whoever is lucky one who get allotment through a lucky draw actually sell out on the first day itself. So obviously access is very difficult in a IPO market. Secondly, all IPOs don't make money. In our opinion, selection is very important. Almost 1/3 of IPOs are actually still below issue price. So if you look at from that perspective, selection is very challenging in IPO market. So one has to be very cautious what to invest, where to invest. The third important is most of the retail investors, as you rightly spoke about it, that they actually get out on the first day itself. But I think that's a very short-term strategy. In our opinion, the way one should look at IPO is an opportunity to buy good companies at very early stage and not just for listing the gain. The real wealth actually gets created when you buy good set of companies where there is an earnings momentum and if it's held for a long period of time. Retail investor actually miss out a lot of value migration which happens in many of these IPO companies. Some of these small cap companies actually become mid cap, some of the mid cap becomes large cap. So people tend to miss out these value migration which happens to in long run. So in our opinion, the way one should go about for a retail investor is participate through a fund which actually looks at these new emerging ideas. Since the institutional participation has a greater access, both in terms of research, both in terms of management, the evaluation would be pretty better off to that extent.
Okay, in fact, there's a very, very helpful graph that is showing up on the screen about all the IPOs that have listed, say, over the last 1 year, and the hits and the misses. So you could really burn your fingers in many of the IPOs, as you can see on the screen. And you can perhaps, I mean, the likes of Paras Defense, etc., have done exceptionally well. But on the flip side, there were so many ABSL, AMC, a couple of others, Sansera Engineering, etc., where people have burnt their fingers quite a bit, investors. So Deepak, that brings us to the next big one, right? Policy Bazaar. It's the largest in the online insurance space. In fact, it's listing on Monday, so everyone's going to be talking about that. Post listing, do you buy or do you avoid?
I think here, Sonia, is, it's a relatively smaller play than, say, Nika or a Paytm. But one of the things that's happening here is a migration from some of the traditional distribution channels in insurance to online. A large part of Policy Bazaar's business comes from the aggregation, but it also comes from actually physically calling people. And if you've ever left your number at Policy Bazaar, my views as an investor and as a customer are probably a little bit different here. So if you ever leave your number over there, they will call you, for a very long period of time. And perhaps these kind of techniques help them in conversion over a larger period, but we have to understand that part of that play is not technology based. It is a little bit of human effort based. So I would not give them an extreme valuation because they cannot leverage substantially using technology. But I think the world is going to move into more types of insurance, online purchase and management of insurance, and more group plans and term plans, which is what I think Policy Bazaar sells the most. So the business that way is exciting. Again, I think we're paying an extremely high price for it, 40 odd times sales. So if this were to go to 80 times, if the stock market were to double its price on it, or even if it were remaining the same, it's 40 times. I think that's a pretty high price to pay for a company where technology has not been the only driver of revenue or primary driver of revenue. And in a space where the competition has been, so you're not an insurer, so you're pretty much, dependent on the insurance companies to kind of produce the product that you should be able to sell. So therefore, you don't have that much in terms of scale, in terms of manufacturing opportunities. And I think I'd give it a little bit less of criteria. However, if you like the space and if they perform, they do some acquisitions, they get into some adjacencies. Longer term, I believe this will be a good play. But then again, build position over time. The first day does not mean that if you don't get on the horse will run away. You'll never be able to get on again. So patience is key here, and we have to wait for the business to perform.
Okay, patience is key. Don't get that FOMO feeling, right, which a lot of people are getting in this market. Well, let's do one thing. Let's slip into a short break, but don't go anywhere. When we come back, we have a whole host of your queries that we're going to solve or we're going to take up with our guests on the IPO market, what to buy, what to avoid, coming up in just a bit. Stay tuned. Welcome back to Smart Money on CNBC TV 18. We're talking about the IPO market. There's been such a frenzy in the last many weeks and months. And of course, you had 3 big IPOs open this week. You had the Nika listing as well, which was big bang. So we're going to tell you what to buy, what to avoid. But in case you don't want to do all of that research, there's a recently listed IPO fund that Edelweiss has as well. So perhaps they'll do all the hard work for you. Bharat, I want to talk about that because, since inception, the IPO fund has done pretty well since 2018 when it began. But tell us a little bit about it. What can investors look forward to? How do you pick companies in this fund considering this such a big, it's a hit and miss kind of situation in the IPO market now. So how do you do the stock picking? Oops, Bharat, I think you're on mute.
Okay, so let me walk you through this fund. This is a thematic fund. The idea of this fund was to pick up good new age businesses which come through an IPO route. Now, we are extremely selective in selecting companies for our portfolio. If you look at over the last 5 years, there were around 180 IPOs which came in. The fund has actually avoided 100 of those names. So if you look at it, it's been extremely selected from that point of view. Secondly, the way we select stock, we classify companies into 2 different buckets, secular growth ideas and cyclical ideas. We have tendency to pick more of secular growth ideas. In cyclical ideas, we are extremely cautious about valuation. We look for niche ideas in cyclical stocks. So if you look at it, our portfolio as of now, we have around 44 names in our portfolio. If you look at it from this year itself, if you look at it, we have actually picked only 15 companies. So we are extremely selective from that perspective. And we typically tend to avoid companies where the debt to equity is pretty high, interest coverage ratio is not very good looking, cash conversion is poor. There is a questionable corporate governance practices historically. The promoter background track record is not so great. Typically, we tend to actually avoid those kind of companies. So that's how we typically select stock in our portfolios.
Okay, I do have a follow-up question on your IPO fund, but if we have time, I'll come back later to it because we have, we're running out of time and so many queries are coming through. But Deepak, I want to ask you about Paytm because, in this case, the company is loss-making, so it becomes even more difficult to justify those sky-high valuations, I guess. What's your verdict? Should one buy it post-listing or avoid?
So we're as a disclosure, we've been very close I've been very close to Vijay, and therefore I respect Paytm for the brand they built and the scale they've achieved. But here's one of the things that I would say, even in Paytm's case, regardless of other considerations, the idea here is the landscape is very big. The banking sector itself is largely inefficient. There's a lot of benefits that a new player can actually bring in, especially with technology, to banking in general. And they have a payments bank today. And I'm expecting that over time, they will apply to become a small finance bank and build themselves more into the insurance space, perhaps into the AMC space. They're already in the broking spaces. Take each of these areas, those are large businesses by their own, and they could use technology to reduce costs and therefore offer a much lower cost offering to customers. They're already a very low cost bank as a payments bank, but I can see them getting into the credit cards, getting into lending. Each of these points that I'm talking about is when news cycle will flow. If they were to be given permission to become a small finance bank and therefore lend, that will be a trigger. There'll be a point which they can, perhaps after this, can launch credit cards. That will be a trigger. So that at each trigger, one gets a better idea of the valuation and the execution capabilities and the execution, actual underlying execution of the company. And that's when you can actually build on positions rather than me just saying, listen, on Monday or whenever they list, I think that's in the next week sometime, just go and place the buyout of the first thing. I think that's a bad idea in general. I would instead put the onus on the investor to actually analyze at each trigger point if they're actually seeing this business scale, and therefore add on more and more capital onto an investment that should typically be small. Now, if you look at all the other IPOs also that you mentioned, a few IPOs are given 300, 400%. Some have lost 20%. So if you're invested small amounts in each, some will obviously give you the 3x return, some will not give you great returns, but net, your investment as a portfolio will start to look better. So I think that is where I would say even a Paytm should be an element of your portfolio rather than the full portfolio.
Okay, Paytm should be an element of your portfolio. Now, I request you folks to just keep your answers a bit short because we have many queries coming in and we barely have 5 minutes left for the show. So, let me first start with Prakhar Pandey, who has written to us. His question is on the 600 crore Latent View Analytics IPO. He wants to know if its long and short-term business prospects make it a good bet. Deepak, what would your comment be?
We like the IPO, good business, not very expensive. They valued it 37 times. Their book value will double because they're raising money. I think inorganic expansion will come. I will buy on more news and perhaps, it's already tremendously oversubscribed, I think. So perhaps not much to bet on in the IPO itself.
Okay, all right. Next up, we have Swapnil Kulkarni, who asks if it's prudent to hold the lesser known names in the IPO space, much like the recent listing Fino Payments Bank over the long term. Deepak, your thoughts?
So we're not covering Fino Payments Bank as a payments bank. Not very attractive, extremely expensive. If it were to scale out to a small finance bank and build lending capabilities, then I would consider it.
Okay, and one more query coming in from Arijit. He wants to know if loss-making companies stepping into the IPO arena just to carry forward the burden to retail investors Is it just a way out for poor investments and companies? That seems to be the biggest issue, right, Bharat? I mean, or rather at least the biggest criticism. Your view here?
Investing in loss-making company or startups is always risky. So you have to be extremely cautious. You need to look at unit economics. What is the addressable market size? What is the pathway for profitability? All these needs to be looked at in. And consequently, you also have to look at what agency businesses these companies can get into, given their current capability and data analytics, what these guys produce. So you have to analyze all these to actually ascertain the value of the company.
Okay, gentlemen, so many queries flooding our inboxes right now, but unfortunately we've run out of time. Thank you so much for joining us. It was really a pleasure understanding the IPO market from you, and we might of course take it up on another day as well, because we have so much coming through in the primary markets. Thanks a lot for joining us. And to you folks, thanks for watching. Keep writing to us. We love your feedback. With that, it's a wrap.